Why do people pay hedge fund managers millions when over 90% of them underperform the S&P 500? Seriously, why would anyone choose worse performance and higher fees? I'm Matt, a chartered accountant, and here's the simple truth about hedge funds the wealthy already know. Most people think investing is a game of beating the market, and the S&P 500, the 500 biggest American companies, is the benchmark to beat. But here's the reality. Over 3 years, about 80% of active fund managers fail. Over 10 years, 85% fail. Over 20 years, 94% fail. And the S&P 500 has beaten them for 14 years in a row. So why not just buy the S&P 500 and retire rich? Because hedge funds aren't designed for maximum performance. They're designed for risk control. Here's what wealthy investors care about. Firstly, beta. How much the fund moves with the market. If the S&P increases about 10%, a fund with a beta of 0.5 might only do 5%. Less downside, less upside. You also have alpha, how much the extra return they generate on top of that expected risk. If they get 7% instead of 5%, that's 2% in alpha. You also have fees, because yes, these managers charge a lot, like 2% of assets plus 20% of profits. So a lot. What hedge funds truly sell is protection. They hedge, that's the name. They use short-term, derivatives, and complex strategies to avoid giant crashes. Because if you're a pension fund managing billions, your number one goal isn't maximum wealth. It's essentially don't lose grandma's retirement money in a recession. That stability, that smoother ride, is what they're paying for. But here's the punchline. Finding the elite 5 to 7% of hedge funds that actively beat the market long term. That's like finding a needle in a haystack, blindfolded, during an earthquake. So for most people, a low-cost S&P 500 index fund held for decades with zero guesswork. This is the smarter and more profitable move. If you want to actually build wealth without paying for underperformance, hit follow. I'll show you how to make smarter money moves every single week.